Gold prices trading lower today, getting as high as 2,060 before reversing lower, going all the way down to 1976. That's quite a significant move. Very reminiscent of the move we saw on February 24th when gold prices declined significantly. But today was a little different, only that it was more of a risk-on trade. Some of those geopolitical risks that have been driving gold prices higher eased a little bit, or expectations eased a little bit. So we did see a significant decline. Again, back below 2,000. It was only above 2,000 very briefly, and only for the second time in the history of gold, which has a long history, much longer than most other commodities and equities that we watch. So a big move back south of 2,000, ends the day right around 1991. Wasn't a dollar-induced move. The dollar was lower today. We did see treasury yields higher, but that likely wasn't the cause either. Cryptocurrencies were higher. So those, we talk about the historical, or at least over the last several years, the three variables that have been sort of adverse to gold prices: a stronger dollar, higher yields, and higher cryptos. Today we saw higher yields and higher cryptos and a lower dollar. So a lot of those historical relationships have kind of gone off whack here during this geopolitical crisis, we'll call it, and ultimately gold prices now falling back towards more normal levels that we're used to. Not quite there yet, still very elevated, but coming down below 2,000 is the start. And gold prices today now may look to reflect more of the global economy as opposed to some of the extenuating risks that we've been talking about. Now, what does this all mean for volatility? Well, if you check out that CVOL index over at cmegroup.com, you will notice that volatility has made a big move higher and resting on those 2-year highs, levels we have not seen since the onset of the pandemic when volatility was all over the map. We have seen it come down, still elevated, made a significant move lower today, but obviously still a ways to go to get back to what we'll call normal in normal circumstances. But given the fact that geopolitical tensions are easing, doesn't mean that there isn't still volatility and risk ahead. We're going to talk about inflation and the Fed in a second here, but volatility coming off with prices now. So if prices send higher again, we would anticipate that volatility will go higher. That's kind of what we've seen on this move. Higher prices translated to higher volatility and vice versa. Now, what do we have for the rest of the week? Well, the significant number this week will be CPI. We get that tomorrow. We are anticipating a 7.8% year-over-year mark. That'll keep us on those 4-decade highs. Last month we saw 7.5%, so still moving in the wrong direction for those of us that don't like inflation. And ultimately, at this point, gold has been a solid hedge against inflation. Now, at these elevated levels, and given the fact that we've seen some pretty crazy moves, it's very unclear as to how gold will react when the number prints tomorrow, if it does, in fact, print higher. Likewise, we'll be keeping our eyes into next week, which is the central bank, the Federal Reserve will be meeting, and is anticipated to raise rates 25 basis points. At one point, there was expectations that they might raise 50 basis points, and obviously, higher rates would be negative to gold. Gold's a non-yielding instrument. But ultimately, right now, the risk of a higher interest rate hike seems to be diminishing. Right now, the Fed Fund Future is only pricing in about 6 to 8% chance of that happening. Obviously, we'll know next Wednesday after the Fed meets, but clearly the Fed looking to take things slower. At least that's what the market's pricing in, and that will help keep gold prices a little higher than possibly if they were going to be more aggressive. So gold prices midweek seeing a significant move lower on easing geopolitical tensions, but look out, we've got CPI tomorrow and FOMC next week.